Every once in a while, someone makes a stock call that immediately gets your attention. And this week comes from Scott Galloway. You might recognize Scott Galloway from his appearances on CNBC. He's also a professor at NYU, an entrepreneur, author, and one of the more outspoken voices in business and technology. And recently, Galloway made a pretty incredible claim. There's a stock trading around $5 that he believes could potentially increase 5 to 10 times from where it sits at this time. And now, anytime somebody says the stock could 10x, I get skeptical because going from $5 to $50 does not happen just because the stock looks cheap. The business has to justify it. So I started to dig into the stock, and the numbers immediately got my attention. The company has nearly a billion monthly active users. Approximately 493 million people use this product every day. Revenue just grew 19% year over year. And the adjusted EBITDA increased from 41 million to $250 million. Free cash flow increased from 24 million to $121 million, and non-advertising revenue grew approximately 85%. Yet the entire company is valued at only $9 billion. So what's this mysterious $5 stock? It's Snap. And the ticker symbol is SNAP, Snap. And yes, it is the company behind Snapchat. And I'll admit something. When I first heard Galloway talking about Snap potentially being a 10x opportunity, I did not understand it. Snapchat, really? This stock once traded above $80. Today it's around $5. Meta owns Instagram. TikTok became one of the most powerful social media platforms in the world. And Snap has spent years struggling to turn into an enormous audience into consistent profits. So why would this suddenly be a 10x opportunity? That's what we're going to find out, because once I started digging deeper, I realized the most interesting part of this story isn't the $5 stock price. It's what Snap already owns. Before we talk about valuations or the $2,000 glasses, we need to understand what Snap actually owns. Snap isn't Facebook, and for many younger users, it isn't really Instagram either. Instagram and TikTok have increasingly become places where you consume content. You open the app and the algorithm decides what you're going to watch. Snapchat is different. Friends send pictures, videos, memes, lenses, streaks, jokes, messages, and it's still heavily built around communicating with people you actually know. And that creates something extremely difficult for another company to reproduce, and that is behavior. Snap doesn't have to convince hundreds of millions of younger people to start communicating through Snapchat. They're already doing it. And social networks become stronger when your friends are already there. If your entire friend group communicates through Snapchat, leaving Snapchat means leaving the conversation. That's a network effect. I think Snap understands this. The company has been moving to reduce the distribution of completely AI generated low quality content in Spotlight while prioritizing more authentic human creativity. And that is interesting because Snapchat's advantage isn't replacing people with AI, it's connecting people. AI can improve advertising, recommendations, lenses, creative tools, but the core product remains people communicating with people. And that made me ask a different question. Maybe Snapchat doesn't need another $1 billion. Maybe Snap just needs to become much better at making money from the billion users that it already has. This is where Scott Galloway's argument starts to get interesting. For years, Snap's problem wasn't attracting users, it was monetizing them. Meta built one of the greatest advertising machines in history. Snap did not, but the latest quarter suggests something may finally be changing. Revenue reached approximately $1.6 billion, up almost 20%. Adjusted EBITDA increased from 41 million to $250 million. Free cash flow increased from 24 million to $121 million. Snap has already been cutting costs, including a significant workforce reduction, which reduced $500 million off the balance sheets. But perhaps the most interesting number is $316 million, and that's Snap's quarterly non-advertising revenue. And it grew approximately 85%. Snap now has more than 25 million paying subscribers across its paid offerings. But that's still less than 3% of the company's enormous monthly audience. What happens at 5% or at 10%? I'm not saying Snap gets there, but that's the opportunity. Snap potentially moves from having one major engine, which is advertising, to two, advertising and direct revenue. And AI could potentially improve both. Better targeting, better recommendations, better ad conversions, better creative tools. And suddenly I understand why Galloway is interested. But if the business is improving this much, why is Snap still around $5 for the stock? In 2021, Snap traded above $80 to around $83. Today, it's around $5. More than a 90% stock value disappeared. But here's what's strange. At the end of 2021, Snapchat had approximately 319 million daily active users, or DAUs. Today, approximately 493 million active users. The audience grew while the stock collapsed, and there were good reasons. Apple's privacy changes made digital advertising more difficult. TikTok exploded. Instagram competed aggressively. Revenue growth slowed. Expenses remained high. Stock-based compensation became a concern, and Snap never built an advertising machine anywhere close to Meta's. There's another issue. Not all Snapchat users are equally valuable financially. Snap continues growing internationally, while user growth in highly monetized markets like North America have become much more difficult. So nearly 1 billion monthly users sounds incredible, but investors need to ask, how much money can Snap generate from those users? And that's why the subscription story matters. But while Wall Street waited for Snap to solve monetization, even Evan Spiegel was spending billions pursuing something completely different. So Evan Spiegel does not appear to view Snapchat as the final product. He views it as the beginning. Back in 2016, Snapchat became Snap Inc., and Spiegel described Snap as a camera company. Over the next decade, Snap developed lenses, computer vision, 3D mapping, AR software, developer tools, and hardware. Spiegel's long-term vision appears to be computing beyond the smartphone. Instead of looking down at a screen, digital information appears directly in front of you. Directions, messages, virtual monitors, translations, AI, digital objects layered in the physical world. Basically, Minority Report in a pair of glasses. And Snap wants to own that platform. And according to activist investor Irenic Capital, Snap has already invested more than $3.5 billion in this project and into Spec's effort. And that's an outside estimate, not a cumulative. That's not a cumulative figure reported directly by Snap. But put it into perspective, Snap's entire market capitalization is around $9 billion. And now Snap is preparing a new generation of specs priced at $2,195. These aren't sunglasses with a camera anymore. They're wearable AR computers. The technology is impressive, but incredible technology does not automatically create an incredible business. So specs can put digital information into your field of vision. Virtual screens, navigation, AI, translation, hand tracking, AR games, photos and video. It's extremely cool technology, but Snap isn't competing against nothing. It's competing against smartphones, a product you already own that fits in your pocket, has millions of applications, and lasts most of the day. Then there's the weight. Normal eyeglasses weigh roughly 20 to 40 grams. Meta's Ray-Ban smart glasses are around 50 grams, depending on the model. Snap specs are approximately 135 grams. That weight sits on your nose and ears. And then there's the battery life, prescription inserts, comfort, appearance, developers, and price. of just over $2,000, which leads to the biggest question. What's the killer application? What makes an ordinary person say, I need this? And we've already seen one of the greatest consumer technology companies in history struggle with this exact problem. Apple launched Vision Pro at $3,499. The technology was extraordinary, but it hasn't become a mainstream consumer product. Meta has taken a more incremental approach with Ray-Ban smart glasses. Get people comfortable wearing relatively normal looking glasses first, and then add more technology. Snap is attempting a much bigger leap, and even the sales math is challenging. At around $2,200, 100,000 specs equals roughly $220 million in revenue. 500,000 specs equals 1.1 billion. 1 million specs equals 2.2 billion. And remember, revenue is not profit. The money already spent is sunk cost. The real question for shareholders is, does this product justify spending the next several $billion? So at around $2,200, normal glasses, if you've ever worn glasses, which most of you have, is around 20 to 40 grams. Meta's Ray-Bans are 50 grams. Snap specs are at 135 grams. And if you've ever worn glasses over, say, a few hours, you start to realize that if the glasses are too heavy or not. Now, if you're wearing glasses that might be 4 to 5 times heavier than normal glasses, that starts to really weigh on your nose or your ears. They have a limited battery life. They do have prescription inserts. The design is bulky, and they're 3 to 5 times heavier, as I said. This is where the story takes another turn. Snap recently separated Specs into its own wholly owned subsidiary, Specs Inc. Snap has said the structure could provide greater capital flexibility, including the possibility of minority investments. And that's important because Snap may have created a way to keep Spiegel's AR moonshot alive without forcing Snapchat to finance the entire experiment forever. My way of thinking about it is keep the lottery ticket, but don't make Snapchat shareholders buy every ticket. Activist investor Irenic Capital has been pushing for greater capital discipline around Specs. Imagine an outside investor eventually puts significant capital into Specs. Snap retains ownership. Shareholders retain the upside if Specs becomes enormous, but somebody else shares the financial risk, and that could be a major catalyst. There's one problem, though. Activist investors don't have the leverage at Snap that they might have at another company. Because Evan Spiegel and co-founder Bobby Murphy control more than 99% of Snap's voting power. You can buy Snap, but you can't really control Snap. And if Spiegel wants to continue pursuing Specs, ordinary shareholders have very limited power to stop him. That means investing in Snap is also a bet on Evan Spiegel's capital allocation. And I think Wall Street may be applying what we could call a Spiegel discount. So maybe the wrong question is, what is Snap worth? And maybe the better question is, what is Snapchat worth? Forget Specs for a moment and look at the core platform. You got advertising and subscriptions. You got AI monetization and improving margins. You got improving cash flow, a powerful network among younger users, and a communication behavior that would be extraordinarily difficult to recreate from scratch. And then separately, you have Specs. You got the hardware, you got the R&D, you got future spending, you have uncertain demand, and you got competition years before meaningful profitability. And the Specs business could actually have negative value in the eyes of investors today, not because technology is worthless, but because investors see the future cash it could consume. So maybe the market is effectively saying Snapchat's value minus the expected cost and risk of Specs equals Snap. So here it is, Snapchat minus Specs equals Snap. And if Specs eventually raises outside capital, Wall Street may finally get a cleaner look at what Snapchat itself is worth. But Scott Galloway is not arguing this should be a $7 stock. He's talking about something much bigger. So now we need to do the math. So at around $5 for the stock price, Snap is worth roughly $9 billion. 10x would imply something approaching $90 billion. That's a completely different company. Snap doesn't get there simply because Wall Street decides the stock is cheap. Snap has to earn it. And here's how I'm thinking about it. These aren't price targets, they're scenarios. In the bear case, user growth weakens and advertising slows. Subscriptions cool, margins stall, and specs continues to consume cash. Snap could remain around $3 to $5 stock price, and maybe even lower than that. And that's the value trap scenario. The stock looks cheap, but the business never improves enough to change the market's opinion. And now the base case. Revenue continues to grow. Subscriptions expand. Free cash flow improves. Management maintains cost discipline. And most importantly, spec spending becomes more controlled, potentially through Specs Inc. and outside investments. And in that scenario, I could see Snap eventually trading somewhere around $10 to $15. And here's what's important about that scenario. Snap doesn't have to replace the smartphone. Specs doesn't have to become the next iPhone. Snapchat simply has to become a better business. And that's a much easier thesis for me to understand. And then we have the bull case. Snap gets dramatically better at monetizing the audience it already has. The advertising improves, subscriptions continue to scale, margins expand, free cash flow becomes substantially larger, and outside investors begin helping finance specs. And now you're potentially looking at somewhere around $25 to $30 stock price. And that's a very different outcome. But when we get to the Galloway case, approximately 50 million or $50 a stock price and a potential 10x. This is where I separate what's possible from what I think is probable. For Snap to approach $90 billion valuation, I think something transformative has to happen. Maybe Snapchat becomes dramatically more profitable than it is today. And maybe subscriptions become a massive direct-to-consumer business. Maybe AI significantly improves advertising economics. Maybe separating specs unlocks value Wall Street isn't currently recognizing. Maybe an outside investor validates specs with a multi-billion-dollar valuation. Or maybe Evan Spiegel turns out to be right, and maybe AR glasses really do become the next major computing platform. And if several of those things happen, then I can see how somebody gets to Scott Galloway's 10x argument. But that's a lot of assumptions. And I don't want to build an investment thesis where everything has to go right. That's where I think the most interesting part of Snap isn't necessarily the possibility of going from $5 to $50. It's that the company may need to get to anywhere close to $50 for the investment to work. And if Snapchat becomes a substantially better business, if free cash flow continues to improve, if subscriptions keep growing, and if Snap can control how much capital specs consumes, there could be significant upside without needing the moonshot scenario. So do I think Scott Galloway is crazy? No, I do not. After researching Snap, I understand why he's interested. I can see the path to $50. I just would not call it the most likely path. The upside is real, and so are the assumptions. And that brings us to the final question. Would I actually buy Snap? So after doing this research, I understand why Scott Galloway is interested in Snap, but I don't think the 10x is the investment thesis. I think the investment thesis is much simpler. Snapchat may be worth considerably more than the market is currently giving it credit for. The company already has the audience, it already has the network, and we're finally seeing signs that Snap may be getting better at turning that network into actual business. Subscriptions are growing and non-advertising revenue is growing rapidly. Free cash flow is improving, and the company is showing operating leverage, and that's what interests me. But there are two different bets hiding inside Snap. There's the bet on, but there are two different bets hiding inside Snap. There's the bet on Snapchat and there's the bet on specs. And I like the first one considerably more than the second one today. That doesn't mean that I think Evan Spiegel is wrong about augmented reality. He may ultimately be right. If lightweight AR glasses eventually become a major computing platform, Snap could own something enormously valuable. But at $2,200, roughly 135 grams with limited battery life and billions of dollars reportedly already invested, I don't think consumer demand has been proven yet. And because Spiegel controls the company, shareholders have limited ability to stop that spending if the economics don't improve. That's why I'm not ready to call Snap a buy based on the research alone. My 20-minute stock hunt score is a 7 out of 10. And my verdict watch list, there are three things I want to watch from here. First is the subscriptions. Second is the free cash flow. And can improving economics become sustainable rather than just one or two strong quarters? And third may be the biggest one of all, and that's Specs Inc. Does Snap bring in outside capital? Because if somebody else starts financing Spiegel's AR vision while Snap retains the upside, I think the investment becomes much more interesting. And that's the potential catalyst that I'm watching. So was Scott Galloway right? Could a $5 Snap eventually become a $50 stock? Possibly, yes. Probable based on what we know today. I wouldn't go that far. $10 or $15 doesn't require a technological revolution. It requires Snap to execute better. $25 or $30 requires a much stronger business, but $50 that requires something exceptional. And that's why Snap goes on the watch list. Not because I think Galloway's wrong, because I think he may have identified something generally interesting, but Snap still has to prove the rest. And that's exactly what Monday Stock Hunt is all about. Not blindly following somebody else's stock pick, finding an idea, digging into the business, and looking for what the market might be missing. And just as importantly, figuring out what could go wrong. So if you enjoyed this stock hunt, make sure to like the video and subscribe to the channel. It really helps the channel, and we got plenty more companies to hunt. And if you want to go deeper into the research behind these videos, join the AI Factory membership at buymeacoffee.com. And that's where we'll be sharing deeper research, portfolio tracking, AI Factory updates, and additional ideas that don't always make it into the videos. And the link is in the description below. As always, none of this is financial advice, and we're here to research companies, understand the technology, study the risk, and hopefully uncover opportunities the market may be missing. Thanks for watching. Thanks for being a part of 20 Minute Stock Hunt, and we'll see you in the next one.